Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the show. We do appreciate it. We're going to be diving into HMB's startup story. It's going to be fun in just 1 second. Real quick, we are gearing up and planning for our May Inner Circle meeting in Dallas, May 8th and 9th. If you are interested in checking out the Inner Circle, please do so at hardmoneymastermindinnercircle.com. And we hope to see you in Dallas in May. Okay. All right. Startup story. So rewinding the clock, like almost 20 years, when we were just getting into business and real estate business, stuff like that. We're a few years into mortgage lending. Jason had a little time as a real estate agent, just trying to figure out where we fit in to the real estate and finance world. And during that time, probably around kind of top of the market, like 05, 06, we did a couple flips and wholesales and stuff. Found out pretty quickly it wasn't our favorite thing in the world, construction and property specific stuff. It's never been the best use of our skill set, especially having more of a lending background. And in doing those first couple deals, we borrowed from a private lender out of Texas and noticed that although we made some money, he made some money too. And he didn't have to do very much besides do the loan and service it, right? And so that, combined with the fact that we already had that background, is what, once we left our jobs, led us to create HMB and to go full-time, fully commit to the hard money lending model.
Yeah, and back up a little bit more. I think our story is probably very similar to yours if you're listening or watching this. As a real estate agent, as a mortgage broker, as a real estate investor, wholesaler, flipper, rental property owner with some experience in real estate, was trying to find which niche was the best. Chris and I, when we were flipping houses, both worked at a lending company. And we realized that lending is just a lot easier than owning real estate and flipping real estate. And we understood kind of the lending component of it. We liked being on the lending side. And if you even back up further, because this is kind of like pre-notion to this story, and this wasn't expecting it at the time, but early 2020s, before, shortly after I got out of college, I was working at a lending company, like a mortgage company. And I remember just traditional mortgages. And I remember wanting to do a loan for this guy. And I went to my boss, Mark, and I was like, listen, like, I can't get this deal done through any of these guys. It seems like a good deal. I can't get it done. He's like, let me see the deal. I showed him the deal and he was like, you know what? Quote him these terms, tell him we'll do it. And I'll be the lender. And I was like, what do you mean? Like, you're not Wells Fargo. Like, how can you be the lender? He goes, I can be the lender. I'll be the bank. I'll be the private lender on this. And that actually opened up my eyes on that. And I can't say that was like our aha moment to get into the business, but we knew that. And Chris and I originally wanted to start like a regular mortgage company. Glad we didn't. That would have been a very bad idea, but that's really where we thought our head was going to be when we were flipping houses and like understood the finance stuff. And, December 2007, we ended up closing our first loan. It was a loan. If you've heard the story, we closed the loan in Indiana, and it was on a project. It was a 3-unit building or something like that. I don't know why we chose to do a loan there. We've never closed a loan there since then. We only do localized loans, but it was a deal that we got. It was a $150,000 loan. We charged 15%, 5 points. We had a private investor who put up the capital. Technically we're still note rate -3 back then as well, because the investor got 12%. We got 15%. We got 3% servicing fee. We got the 5 points up front, which was $7,500 plus some junk fees. Yada, yada, yada. We had some prepaid interest, yada, yada, yada. We had about $10,000 check that was made out to a different entity because we didn't even have Hard Money Bankers at that time. And we deposited that loan into Hard Money Bankers, and that was our $10,000 startup capital that we were able to go into January 2008 with.
Yeah. I mean, a little context about that period in time. Some people listening and watching right now were in business then, some weren't. And the way, that crash, the real estate and financial world crash, like, it was something. Like it was doom and gloom across the board. A lot of our friends and obviously business associates were in real estate and finance and stuff, and everybody was hurting. Like values had just come down so much, stock market crashed, some Wall Street firms going out of business, like investors were hurting based on the properties they owned. Private lenders were hurting, and a lot of them went away. And just everybody, like realtors, mortgage people, like everyone was feeling the pain. That's when we started. It was, in hindsight, a great place to start because it was at the bottom. Like the values had already dropped, and we were super careful. We were super nervous about doing ultra safe loans just because of what the market had just experienced. And like raising capital during that time was challenging. People were afraid to invest in investment real estate. They were. And we were scraping together like a little bit of friends and family money and like the associate of somebody we knew or like somebody's relative, and like kind of pulling together in real time the capital that we needed to close the few deals in our pipeline, right? Close like, I don't know, 1 or 2 a month starting out. And it was, the capital was coming together real time. It was a lot of work, a lot of heavy lifting, and it just kind of came together. Also, the liquidity in the market in our space, like if you had capital, that alone made you very popular amongst local real estate investors. They couldn't find private lenders, and the ones that still had capital were afraid of the market. So like it was a very, very different time than now. It was challenging, but it was, in hindsight, obviously not something we would want to go through again, but it's a good startup story. Like it was a good, trials and tribulations, like, fighting to get a business going and it coming together slowly over time.
Yeah, for better or worse with that market, there was good and bads. I mean, we're firm believers that there's always a time to buy real estate, sell real estate, lend on real estate, trade real estate. Like every day is that day, right? At the right numbers. So like
Right.
it didn't, kind of didn't scare us, but at the same time, like what you know, and you learn what you learn from the past. And I don't want to go really off on a tangent on this, but like if you've never read the book Psychology of Money, like go read the book Psychology of Money because it had a lot to do with it. We were talking to one of our partners, Ryan, the other day, who's been with us for about 3 years or so, and he was like, "I'm just going to take your word for this because I wasn't there back in the day, and I don't know what you guys
Right.
saw." And we're like, "Trust us. Like, don't do this." Like, if you asked us like what our biggest takeaway was we started from scratch. We started at the bottom. We were terrified to write bad loans. We were terrified. We were ultra conservative over and over and over and over. To this day, we're ultra conservative because we were terrified to lose somebody else's money, because losing somebody else's money is way worse than losing your own money. And we were so terrified to do that I'm sure we passed on endless good opportunities because we were too conservative. And to this day, that's the same thing we preach. And I am very, very concerned with a lot of the private lenders that have jumped in this space for the last few years. And the reason why is they've jumped in the space, they've done some deals. They might think that they're good deals, although they're probably aggressive deals. And the market's continuing to go up. The deals have continued to perform. And I hate to say it, but they might not have even learned anything from them because, hey, I did a deal and it was a good deal and it paid off. And I did another deal and it paid off. And I did another deal and it paid off. And that's fine. But what happens when there's a hiccup in the market? The institutional lenders, if there is a 5% tick in the market in the wrong direction, down tick, I don't know if that's a word, but if the market goes down by like 5% or 10%, the institutional lending deals are freaking screwed. I see the numbers every day and they're screwed, and you gotta be cautious. If the market's good or if the market continues to go up, everything's going to be good, right? Like you write bad loans and they're good, but like, I know that we had some, I can recognize that we had a few bad loans that we wrote on our books that we ended up getting out clean because of the market. There's areas that we were scared to lend $100,000 in, 15 years ago, where now I see stuff selling for millions of dollars. And again, we're going to adjust to today's environment of where we're comfortable lending. But, a lot of this has to go with like, your past experiences. One thing to note is there was no education in our space back then. The only education that we had was chatting with a few like older attorney-like people that lent their own money out, and they were like the private lenders. There was no like full-on hard money lending operations and companies. It was a lot of one-off private lenders, and yeah, some hard money lenders that might have pulled cash together and things like that. And it was like, please let me take you out to lunch so I can see, what type of portfolio you have or what types of deals you have or how you structure that. And there was no playbook. There was no blueprint. There was no exact formula. Everybody looked at things different. Two private lenders that were best friends would have lent completely different on the exact same asset, exact same project. And I recall us always saying that there's no place for institutions in this model because everything's very unique. There's not enough volume in this space. And there's no way for institutions to be able to come into this space to underwrite deals correctly. And yes, they came in, and I think a lot of the institutions were very successful over the years as the rates were cheap and the market continued to increase. But, things change.
Yeah, I mean, it was a wild time back then because, the one thing that we did have starting out, and we didn't have much, but we had deal flow. Like when hardmoneybankers.com went live and we pieced together our email list from our business contacts. We started marketing. It was even before like social media was really going. And we started putting the word out that we had private money to lend. We had deals to look at. People were searching for capital. So we had stuff to look at. We're actively raising capital. I remember we were at very first, we had left our jobs. We had closed a deal or two and we go full time into this thing. And we are working out of the back of a mortgage company. It was even before we got to the title company. You heard that story too, but we'll get there. We were working out of the back of a friend's mortgage company because his mortgage company was going out of business because of what was happening in the market. And he had a bunch of office space he wasn't using. Everyone was gone except for a couple people. And he still had the office because his lease wasn't up for like 6 months or 4 months or something like that. And he didn't want to get dinged. So he just continued to pay the money and perform on his lease. So the first few months we were there and it was just, like there's so many things were different. Like I wasn't even used to going to work dressed casually in a t-shirt or whatever. And just walking into the building and saying like, we're in here to make something out of nothing. And you don't really know the roadmap. It was our first business. Like we didn't know how you build out the infrastructure of a company. We were just feeling it out every day. A lot of keystrokes, a lot of phone calls, a lot of like, what do you think is the best way to do this? Like double data entry, triple data entry. We're just typing our stuff into different places to process loans.
Never really thought about it like this, but we had so much trial and error. But I will say that pretty much all the loans that we ever did were so ultra conservative because, again, we were so terrified to lose money that like we didn't have too many major hiccups. I mean, not that we didn't have hiccups, right? Not that we didn't have defaults. We had foreclosures. We brought a new investor on, and he
took a while, though.
And he trusted us with $400,000 of his money, and his first deal defaulted. Which, if you've ever heard us talk, you can't have the first deal default with a new capital investor. That's a no. And it defaulted, and that ended up being a great thing because there was no capital that came in for a year. Then he got all his money back plus default interest. He was thrilled, and he went all in and started and trust us with millions of dollars that he could have lent with. So like, that's a different story, but there were so many trial and errors, but like, we had a motley crew of people that were working with us. We're like, oh, hey, real estate and you're looking to make some extra money. Let's try to originate loans. Your business development, you're this, no W-2 employees, but like a lot of people that were like commission-based, like, help us with this.
You could bring in deals. If you can bring in deals, you can make some money, right?
Yeah. Help us with this. Help us with that. Oh, you want to be a capital raiser? Go help us with that. Like, obviously there's a lot more structure in place now than there was in the past, but you don't know. It's like, oh, we can't afford a salary. We didn't even take out our own salaries. I mean, in essence, the way that we've always, even to this day, the way that you take out capital is cool. You make a bunch of money in your operating account. Approximately what your expenses are going to be the following month. Cool. Let's take out the rest of the money and we can, take a distribution.
Yeah. I mean, all of it's so manual, like paper copying files, handwriting checks before I even got set up on QuickBooks. And our first CPA taught me how to use it, like amateur hour stuff. And it was wild to see how it came together because it wasn't like overnight, but it didn't take that long either. Like closing X amount of deals the first year. And it's like, okay, now we can afford, like we couldn't be in that mortgage company anymore because their lease was over. So we found a title company and we could work in the back of their office and we paid $500 a month for that space. And we had a bunch of space. And, just putting together all the basic stuff. It was a pretty wild time and the deals kept increasing. Like our name was out there. I remember one time we went to a RIA meeting because we had a lot of RIA meetings back then. And we asked the audience when we got up to do a little 5-minute thing on we're HMB, we're lending, here's what it looks like. And I remember the number one question was like, do you ever run out of money? Because people just wanted access to capital, and whoever had it and paying 15 and 5 was fine. And I remember after not too long, it was like a year and a half, we're at one of these meetings and we're doing our 5-minute spiel. And we asked them, how many people here, raise your hand if you've ever heard of HMB, hard money bankers. And this is in a big metro area. We're a small company, we're a couple guys, big metro area. And the majority of the room raised their hands. And we were kind of like wowed by that. Like all these people know of our company's name. And it just shows you it was a very, very different time in the market. Like just having capital made you really popular. These days, private lending companies, institutional or private or otherwise, are all over the place, deploying tons of money. Like it's just a very, very different time. But that's our startup story. That's how we got into it. And it grew from there. Like it was like the first handful of years, it was like doubling every year. Some people, like the commission originators we were talking about, started to fade away, go to do their own thing. We started hiring W-2s, like starting with an admin, then an accountant, building out the team slowly over time, moved to a better office. It was only ours, instead of sharing the back of a space. And it came together. And it's still like pretty cool to think back on that time.
We spoke at an event maybe about a year ago, and somebody raised their hand at the end and said, what's your one or two biggest takeaways that you would give as advice to anybody who's starting a hard money lending company or owns a hard money lending company? Number one is, fundamentals and understanding the business and doing the business yourself. I know too many lenders just want to throw capital at something, or they just want to kind of dive in and potentially do it without doing it the hard way, or without learning, or they just want to employ people to learn things. Like we did the books, we did the marketing, we did the underwriting, we did the processing, we did the investor relations, we did the business development, the marketing, the speaking. Like we've done all of it. Like we can train any employee on any job inside of our business because we are actively involved and did that. And I think that's important. And I think too many people don't really know some sides of their business, and they overlap. Like, for instance, if some of our employees like had to go away, like we could step in and operate the business. It would suck because we would be trading, a ton of time in order to do so. And that's why we pay employees money to, free up our time, but we could do that. And I know a lot of hard money lenders can't do that right now. So that was number two. Now, number one. Number two, the absolute most important is treat and think yourself as a marketing company, and everything's deals. If you have a bad deal, you will go out of business. If you have good deals over and over and over, like really good deals, you will be extremely successful. That's all it takes, is finding good opportunities. Like we weren't planning to be like marketing people. Like that was never the goal at all, to be marketing people. But like we started, marketing, and this is like, YouTube was only 2 years in at this point. Like, right. We started, going to RIA groups, sending out mailers, sponsoring events, speaking at events, handing out business cards in the freaking dozens a day to every single person that we saw. We had tons of business cards, bang, 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 creating email databases, finally doing digital marketing, creating videos. All you got to do is go on YouTube and descend or ascend by the latest YouTube video, the oldest YouTube video, and you'll see some awful videos that we created back in the day. That's just what it was. Like you got to start somewhere. And it's just all about marketing. And there was a rule that we learned early on. Like we always thought when we got into this business that finding deals was going to be the easy thing and finding capital was going to be the hard thing. And they're both hard. They're both hard to find at the right time. That being said, every capital investor that we spoke to early on was extremely receptive to this business. I get a high interest rate return, first mortgage, co-lending, blah, 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 blah. Yeah, sounds great. Go find me some deals. And it was hard to find good deals over and over and over and over. Like that's your job, finding good opportunities, finding good deals on a regular basis that are not going to default. Because guess what happens? You do a bad deal, the loan defaults, you're chasing borrowers around from payments, you're spending money on foreclosures, you're stepping into paying tax bills, you have a humongous headache, you're playing defense all day. to try to clean up this deal. That's only one side of it. And on the other side of it, if it's not your money and you have a capital investor, you have a capital investor that's pissed off, a capital investor that's suing you, a capital investor that's whatever. Like you can't do bad deals, right? It's hard enough to get the borrower, your borrower or client to, get in good standing. If you're fighting with them, the last thing you want to do is also have to fight with some sort of capital investor. You will get out of this business too quickly if you have too many defaults. You got to be cautious. You got to be safe. And that's another thing that I think a lot of new real estate or hard money lenders, don't take serious enough. Like just go find good deals over and over and over. Spend a lot of resources on that. It pays out in dividends on the back end. And if you have good real estate, good deals that you're lending on, you're going to have very, very little headaches on the back end. You're going to have good quality borrowers. They're going to make their monthly payments. They're going to repay. You're going to have happy capital investors that tell all their friends and invest more money with you. And it's one good, very, very awesome cycle.
Good stuff, guys. Hope you got some value from our startup story. We certainly did, living it. If you haven't done so already, go check out Hard Money Mastermind InnerCircle.com. We hope to see you at the May meeting in Dallas, and we'll see you next time here on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.